Investing in stocks is a great way to increase your wealth. However, many beginners actually end up losing money rather than gaining it. Let's explore all the mistakes newbie investors make when it comes to buying and selling stocks. The first mistake that people make is not doing proper research. Ignorance may be bliss in other parts of life, but not in the stock market. If you want to walk into the stock market completely blind, you can expect to suffer losses. One of the major problems is that there are just so many resources to look into when you first get into researching the stock market. The internet is full of online magazines, blogs, and wannabe financial experts that are posting their advice left and right. For a newbie, not only is it extremely difficult to sift through the torrent of information, but it's also very hard to know which advice is the right one to follow. We recommend always keeping the following words in mind. It's your money. Nobody cares about your money the way you do. They don't have the same stakes as you. That's why it is important to take all free advice with a grain of salt. Always try to consult professionals who have been investing for several years. Try to cross-check your sources and get advice from different people so that you can make more informed decisions. Keeping with the theme, it's your money, not theirs, we also want you to carefully evaluate conflicts of interest while you go about doing your market research. What does this mean? Well, if a person such as a broker or an advisor is giving you investment advice, their interest lies in the fees you pay them, not in what happens to you and your money. But what about financial advice from friends and family? One of the major problems in this division is that friends and family will only give you a biased view of their investments. People filter out their losses and mistakes and only boast about their best decisions. Next up, we're going to need you to stop ignoring global events and market cycles. Big picture thinking is very important in the world of stock trading. There are many external factors that affect the stock market, including the greater economy and market of your country and the world. Market cycles refers to how the economy tends to expand or deflate. Expanding cycles include booms, during which business growth is at an all-time high, employment rates are rising, and inflation is under control. This is generally considered the best time to invest in the stock market because businesses tend to give out generous dividends to their investors. However, during economic downturns, businesses lose customers and start going into a loss. They often have to cut costs, usually by downsizing their workforce and cutting down on returns to investors. By reading analytical articles and keeping a close eye on the economy of your country and the world, you can ensure that you look out for the signs of economic expansion or downturn. Keep in mind that due to increasing globalization, the stock market is more affected than ever by major global events. For example, the day after 9/11 terrorist attacks, the Dow, which is a trading index consisting of 30 prominent companies, fell by 7.1%. Overnight, people went into a loss because of events that were completely out of their control. Due to the sudden drop, many people started panicking and selling their stocks at a loss. Those who waited it out until a month after the attack, however, got rewarded as the indexes went back to normal. Another big mistake: making emotional decisions. As a human being, you're going to have emotions about everything. When your stock takes a sudden dip, you're going to feel fear. You might also feel intense attachment to certain companies. So you'll hold their stock with dedication even when they are going into a loss. It's important to acknowledge that these emotions exist. Those who try to ignore the emotional side of investing are making a grave mistake. It is better to master emotions and learn to control them rather than ignoring them and letting them build up inside of you. For this reason, we recommend that you begin reading up on behavioral finance, which tells you about the psychology behind different investment decisions. An example of behavioral finance is the concept of herd mentality. This is one investing behavior in which people tend to start mimicking each other, or they start doing whatever the popular norm is. In 1990, it became trendy to invest in internet.com companies. This wasn't always the best idea, as these companies were not well managed and did not have a very clear direction for the future. A combination of press and herd mentality helped raise the value of their stock all the same. FOMO, aka fear of missing out, is a common driver of herd mentality. People hear about the trendy new stock that people are buying, and they begin to wonder if maybe they should get in on the action. Of course, it's entirely possible that others are correct and that the new trend will earn you a profit. However, it's important to conduct your own independent research first on the company and the stock. What are the company's long-term prospects? Its current price may be high because many people are buying it, but can it sustain over the next months or even years? We've said it before and we'll say it again. Making informed, empowered decisions about the stock you trade is much more important than blindly following the advice of the masses. Next up, we should talk about how many new investors suffer from greed. In other words, their biggest mistake is wanting money too quickly. Greed is one of the many emotions that we feel when we begin investing. It got its own section in the video because it's very important not to have a greedy mindset when you enter the world of stock trading. Many people come into this world thinking that it is just a scheme to make some fast cash, or they assume that it will make them millionaires overnight. This results in investing decisions that only fulfill short-term goals, but end up driving into a loss in the long term. One of the first mistakes that people make when they are being controlled by greed is frequent buying and selling. As soon as there is a dip in the market, investors abandon their stocks and start selling, which causes them to go into a loss. The idea of holding a stock through tough times is unknown to the average greedy investor. There's a reason why people say that investing in stocks takes time. Warren Buffett did not become rich overnight. He was trading stock for decades before the riches came. Like the tortoise, you must remain calm and go slow and steady until you win the race against the overconfident rabbits. Another fairly newbie mistake is ignoring fees. Investing in stock seems like an easy concept. You just take your money to a broker and start putting it into different companies. However, investing almost always comes with additional costs. Fee structures in investment companies have historically been terrible, with various hidden fees to trick new investors into spending more money than they need. Even as things improve in the modern age, especially with the onset of apps such as Robinhood, a new investor should still be wary of any catch that comes with investing. A fee percentage as simple as 1 to 2% may not seem like much at first, but after decades of it eating away at your profits, you may start to think about the opportunity costs. We recommend using online tools and fee analyzers to calculate all of your costs and track them very carefully throughout the investment process. Lastly, not having a diverse portfolio can really hurt your chances. Non-diversification is one of the biggest stock market mistakes. Non-diversification is when you keep putting your stakes in one or two companies. People often do this when they are overconfident or overly loyal. For example, people who have been investing in Apple may continue to do so even when the company performs poorly, because they have faith in the firm's ability to bounce back like it has in the past. Whether this faith is misplaced or not can make or break your profits. Diversifying your portfolio means putting your money into multiple stocks, so that the amount of risk is distributed. Minimizing risk and maximizing profits is the key goal of the stock market trading. Creating a diverse portfolio helps you weather out the bad conditions. For example, market dips, periods of uncertainty, and economic downfall, etc. Try to include companies from different industries and categories in your portfolio. Always think about a company's long-term perspectives before adding them to the list. That's all we have for today. Don't forget to hit that like button and comment down below the best investment advice that you've received in 2021. Don't forget to subscribe to our channel and hit the notification bell so that you never miss another video.